What's up, North Shore? My name is Daniel. I'm with the always incredible Stephanie Weeks. And y'all, today we're going to be talking about the housing market crash. Everyone is asking about this crash. They're saying, when's the crash coming? When's the bubble going to burst? And you guys, we have some news for you. There's no crash. There's no bubble. To our knowledge, right? So we study the data. We look at it almost every single day, and we do not see a crash coming. And I'm going to explain to you why. But first, I want to just talk to you about the crash versus a little bit of a softening in the market. We are definitely seeing a softening in the market, right? So listings are staying on the market a little bit longer. There are more price increases, right? So that's completely different from the crash that we saw. Price decreases, okay. Correct. Is that what I said?
Yeah, you said
Let's try it again.
That's all right.
I wish. So we have price decreases. We're seeing that more in the market, right? But this is not the 2007 crash bubble, right? And actually, that was dealing with lending. So can you explain a little bit about what happened when the market crashed legitimately?
Yes.
And what led to it?
Back then, I remember it so well, right? It's like we had so many things going on. And right around that same time, or just a couple years before, we even had Katrina on top of that. Yeah. So Katrina didn't affect everybody, obviously, across the country, but that really affected us along with that. So what was happening is there were some, let's say, bills passed, maybe that's not the exact right word, but said, hey, everybody deserves a house. So let's just figure it out. So you had loans with no money down, 580 credit score, don't verify the income. I mean, you were basically asking for a major problem.
Right. If you had a credit card and a driver's license, they'd be like, oh, here's a house, here's a $500,000
Yeah, a driver's license, and you could read. They had a mirror. Yes, and that was pretty much it, right? Yeah. And so you ended up having just a ton of foreclosures is what ended up happening. And here we had Katrina, and then all the prices went just skyrocket because there was no inventory and there was desperate people for houses. Yeah. So, and you had things like that across the country, not necessarily Katrina, but just the rise in the prices and the affordability supposedly of the easy mortgage loans. And then everything just kind of crashed from there because it was like, I mean, if I make $100 a month and I go try to get a loan with $100 payment, even though it happened, it can't work, right? And so at some point, something's got to give. And I feel like everything kind of crashed at the same time, foreclosures everywhere. Like it was just a big mess. And what I heard so many times, it blew my mind, was that, well, everybody's foreclosing. Like that's what people would say. Like not necessarily, yes, I lost my job. Yes, this happened, so on and so forth, of course. But a lot of times it might have been something not even so dramatic. And I just kept hearing, well, everybody else is foreclosing. Everybody else is foreclosing. And I was like, oh my gosh, I can't understand that.
And the thing about that is, y'all, is like when the shift happened back then, everyone that could at one point afford the house was now unable to afford the house because they were underwater, right? Yes. So right now we are absolutely seeing a shift. We are seeing a softening of the market, right? But the lending practices have tightened. So people can still say there are foreclosures happening. And there are things that could possibly be coming because there's been a forbearance in effect, right? So there are some things that we are studying and seeing in the market. I just wouldn't call it a crash or a major downturn. It's just a softening for now. And if we're wrong, we'll come back on here and say, hey guys, we're seeing a crash, right? But that is not what anyone is predicting at this moment because it's not the same set of circumstances that we saw back when it actually did crash. Now, in the past couple of years, we had the pandemic, then we had these incredibly low interest rates. So what happened was everyone that could move or could afford to move did because they were taking advantage of those interest rates. Yeah. So we had all these people, all these buyers getting approved at this 2 and 3%, and then we had not enough sellers for them to purchase the homes. So we were seeing a lot of buyers and a lot of sellers, which created a huge seller's market. That's when this whole thing began. And so right now what we're seeing is as the interest rates are creeping up, we're above 5% now. When in January, we're in the 3s, 4s, and now we're in the 5s, right? So as it's happening, we are seeing less buyers and the sellers are still here. Now, as the sellers begin to come out, and we're seeing these price decreases. I said it right this time. The price decreases, that is going to actually, in my opinion, be a better set of circumstances because it's going to allow these houses that used to go off the market in 1 hour, have 50 showings, 100 offers, right? So that's going to actually become a balanced market, right? So that's the key is now we're in more of a balanced market, even though the interest rates are still high, which 5%, 5.5%, 6% is really not that high
Right.
over the long run, right?
It's totally not. I mean, I think I bought my first house when I was 18. That was 6.875. And then when I bought my second house was right around, I want to say 2000 maybe. And that was 8%. And those are with excellent credit both times.
Right.
And then, of course, you hear people 13, 14, 15%. I mean, I wasn't in the business for that, but we've just been really spoiled to these 3% interest rates we've had for so long. Like
that was unsustainable.
It was falsely held low.
Correct. Yeah.
It was falsely held low.
Yeah. And so these interest rates that we're seeing now is a more sustainable interest rate so everyone can make money, right? And actually, guys, if you're thinking interest rate, let's change that narrative and start thinking your monthly payment. So what are you going to be paying per month on a home? And what we're starting to see in the, mostly East Coast and West Coast is those markets, yes, are in more of a decline, a steeper decline,
yes,
because those houses are way more unaffordable, right? So we have $500,000 or $600,000 or $700,000 as your median price point.
Right.
That too is unattainable, right? So on the North Shore in the Louisiana area, we're actually a little bit more insulated, right?
So like
We have a nice little bubble.
In a good way.
In a good way. Don't say bubble.
Good bubble.
It's a good bubble. But yeah.
It's like fun little bubbles when you're 3 years old and you're blowing them around. It's like the good bubbles, not the bad
beautiful. I love that explanation, right? So what we're saying is that we're kind of insulated a little bit. I'm gonna say insulated and not bubble.
All right,
but we're more insulated on the North Shore. And another thing that's nice is with the new FEMA 2.0, we are a little bit raised higher. So it's actually going to still allow us to stay in this nice little market, right? So we're a little bit more insulated. We have a more balanced market. So I'm predicting a crash or a major downturn. We are in a softening. This is still the summer, which is a very popular time to move, very popular time to buy a house. So what I would recommend you guys do is get with a very experienced real estate agent like myself, get with a very experienced lender like Stephanie Weeks, you guys, and kind of get everybody on the same team. We work together to get you the best deal and in the best home. And that's the biggest key is if you have a professional working for you, it's actually not as scary because let's just be honest, moving and buying a house, it's kind of a scary thing.
It is. It really is. But it's easy when you've got the right team that you can work with who's going to guide you step by step. And you'd be very surprised at how many people are like, on one hand, the interest rate is so bad, so bad. On the other hand, I'm like, well, here's the payment. Oh, well, that's right about what I thought anyway, right? So let's focus more on the payment and the affordability and make sure that's in your budget and not so much on this rate versus that one, because sometimes buying those lower rates don't make sense, and that'll be a whole nother video.
Right, yeah. So you guys, I would highly recommend that you reach out to Stephanie or myself. We'll get you on the right path to home ownership. We'll be able to inform you about the market, tell you all the current trends. So give me a call at 504-908-7572, or you can reach out to Stephanie.
985-300-LOAN.
Love it. You guys, we will see you on the next one.
See you in the next one.